Okay, so now I'm going to talk about what is our flagship investment product, the True Potential Portfolios. We now have over £1.2 billion within the portfolios since we launched in October 2015. So the first thing that I'd like to do is to thank you all for your ongoing support. It really does mean a lot to us here at True Potential. Okay, so let's have a look at the performance. And the first thing to say is we're very happy with the performance over the month. As you can see, we've received positive returns from all portfolios with the exception of the defensive portfolio. And that's because bond share prices have come back a little bit over the month. However, it should be noted that if you buy a bond with a positive yield to redemption and hold that bond to maturity and get paid at par value, you do not lose any money if prices move down during your holding period. Also, if we look a little bit more in depth at the performance figures since launch, you can see that investors have been rewarded for taking extra risk during what has been quite an uncertain period. And now virtually all the portfolios are offering double-digit returns over the year. Okay, I think as well as that, when we talk about returns, it's quite important to not just look purely at the return itself, but also to the outcome. And what I mean by that is to look at the risk levels. So how did we actually get that return? And that's something that we look at very heavily here at True Potential, and also something that our fund managers look at very much as well. What we aim to offer is a good risk-adjusted return. And what I mean by that is aiming to maximize the return, but within a specific risk band. We will not take more risk than we feel is necessary, and certainly not sufficient enough to move an investor outside of their chosen risk category, which is something that we continually monitor. Okay, so let's move on to the key themes. So every month we sit down with our fund managers and we ascertain exactly what their views are, what their outlook is, and we can bring all of this information together. And we've got two key themes this time which I'm going to discuss. First is around emerging markets, and our fund managers have seen a lot of positivity around both emerging market equities and emerging market bonds. I think the key question for investors at the moment is what will happen if we see a US interest rate rise? And we're seeing sort of mixed views on that. Some people are quite nervous that there's a lot of emerging market debt that is denominated in dollars. And what you could see is that become more expensive for the emerging market countries to service. However, on the other side, you're seeing a lot of people who believe that emerging market countries now very much have they feel a lot more in order. And actually, what you're seeing is a greater intra-Asian trade relationship. Okay, the other key theme that I want to discuss as well is just around the bond market. And obviously, you've seen yields at incredibly low levels. What we're seeing with our fund managers, though, is that they're positioning very much short duration, so less sensitivity to potential interest rate rises, or they're looking to hold cash or cash equivalents instead of actually holding more fixed interest. So let's have a look at the changes that we've made within the portfolios, and we've made changes to two of the portfolios. First is balanced, and the second is growth. So let's start off with balanced. And we needed to make a change here to help to optimize on risk for the portfolio. So what have we done? We've reduced down the position in the True Potential Close Brothers Balance Fund. We've also reduced down the position in the True Potential Allianz Balance Fund. And we've put a little bit more money into the True Potential Schroder Balance Fund. Looking at growth, what have we done here? We've reduced our position in the True Potential Allianz Growth Fund, and we've placed the proceeds into the True Potential SCI Growth Fund. So let's have a quick look at the rationale now. So the Close Brothers and Allianz funds currently carry the highest risk within the portfolios, with both having a large position in UK gilts, an area many of our managers are negative on at the moment. Schroders has a high level of diversification, fund manager diversification, and it's also got quite a low bond exposure, with the fund manager preferring to hold cash or cash equivalents instead of holding bonds. Looking at SCI, they're very diverse, and their position in the growth portfolio has increased due to their consistency and their volatility control. Okay, that's everything from me. Thank you.